Let's have a look at some examples of how we would apply accounting assumption number 3, the period assumption. So let's take example 1. A business prepares its financial reports on a quarterly basis every 3 months. So there's a report or a period from January to March, second period from April to June, third period from July to September, fourth period from October to December. So 4 periods a year, 4 quarters. However, at the end of December, the business signed a contract with a client for a job that will take around 6 months to finish. So what they've decided to do is, if we sign the contract here, we're not going to finish that job until another 6 months. So what we will do is then prepare our next set of reports then. Makes sense? We'll finish the job then. So I will wait 6 months and record it and prepare all our financial reports then. Is this the correct decision? Well, we're going to say no, because the period assumption has been breached. Why? The reporting periods of the business must be of equal length. Last year, period 1 was from January to March. That's 3 months. This year, it was from January to June. It's 6 months. We cannot now compare period 1 this year with period 1 this year. Not only that, we can't compare this period with the previous period. The lengths are different. So the period assumption says the periods must be of equal length. Otherwise, we're just unable to compare our profit and performance over time. Example number 2. A sole trader business, which is one owner, calculates its profits and prepares its financial reports once every 2 years. Why? Well, it's one owner, so the owner of the business has no one to help him and has no time. So what happens here is the business waits 2 years before it reports on its profits and its assets and so on. So each period is 2 years. So we've got one period for 2021 and 2022, then another one for 2023, 2024. The third period would cover 2025 and 2026. Is this acceptable? Well, now the periods are of equal length. There's no problem there. The only problem here is the period assumption is still being breached. Why? Because whilst the periods are of equal length, they are too long. The maximum length of the reporting period that is allowed is 12 months. Why? Well, there's a couple of reasons. The shorter it is, the better you can compare your performance. So when we look at our qualitative characteristics, we've got one called timeliness. We need timely information. That basically means having information sooner. So we get a better comparison if we compare things more regularly, and definitely not if we wait for 2 years. And also, most importantly, the business must pay its taxes every 12 months, so therefore it must prepare its reports every 12 months. So that's another breach of the period assumption. Example number 3. A business which prepares its reports monthly has had a bad result for March. So let's look at January. Revenues 50,000, expenses 30. So we're matching here, revenues with expenses. We get a good net profit. February, revenues 90,000, expenses 40,000, equals a profit of 50. March is not good though. We've got revenues of 30, expenses of 60. That's actually a net loss here of $30,000. Why? So what we've decided to do is said, well, look, it's all the same. Why don't we take $40,000 of revenue here? So take it from there and put it over here. So instead of being 90, we'll get rid of 40 from that. So that's now 50, less $40,000 of expenses. They stay the same. We've got a little profit here. And the beauty of that is we're going to bump this up from 30 to 70. And now we've got a little profit here. So if we just go back a step, we will see for the 3 periods, if you add it up, profit was 20, 50, so that's a total of 70, minus 30,000 loss. That's a total of $40,000 profit over the 3 periods. Well, if we just do our little adjustment there, add it up, 20,000 plus 10 plus 10, it actually equals the same. Can we do that? Is that acceptable? We're going to say, no, it's not. The period assumption has been breached. How so? Well, the net profit for each period must match, we use this matching concept, the revenues and expenses for that period. Under this approach, we've actually got the revenues for February in here, and they're being matched with the expenses from March. That's wrong. All the revenues for February should be included in February's period so we can match it with February's expenses. One more example. In 2021, a business paid for a $30,000 van to use to make deliveries to customers for the next 3 years. There's a topic called depreciation. We'll look at it later. We're not really going to deal with it now. This is not quite a thorough example. It's just one to demonstrate the point here. But we're going to say we're going to use that. That's called economic benefits. We're going to use the economic benefits of this $30,000 van in this year, and this year. So that's what's going to happen. So we're going to use the van for 2021, 2022, 2023. However, the business has decided to record a $30,000 expense for the van in 2021. Is this correct? We're going to say no. period assumption has been breached. Why? Well, the van's going to be used for 3 years, as in we're going to get economic benefits from it. And one of the things that the period assumption allows us to do is sort of distinguish between expenses. So here's after 1 year, we'll have used that. But when you think about it, for these 2 years that we haven't used, they're actually assets. They're economic benefits we will use in future periods. And that's the beauty of the period assumption. We can now differentiate something and use this approach here, which is correct. Expense in the first year of 10,000. And then we've got unused economic benefits in the future. And that's the way it should be done. That way we're going to be matching our revenues and expenses with the correct period. And we're going to have our financial reports are going to be more accurate.